just very. Well, good morning, everybody. I see that there's several participants that are still joining, but it's the top of the hour. We'll go ahead and begin. Thank you for joining. My name is Clark Taylor. I'm the Director of Wealth Management, Managing Partner over Wealth Management. I'm excited to have our team on today. We're grateful for this opportunity to provide our quarterly economic and market outlook. Just a couple of housekeeping items before we begin. We will record this webinar for those who are not able to join, so that this will be available after the call today. There is at the bottom of the meeting a Q&A feature. We would welcome any questions at the end. We'll take some questions. If there's a question you'd like to ask, please go down to the Q&A feature and pose your question. We'll get to as many of those as we can toward the end of the meeting. With that, I think we'll go ahead and start. We're excited to have on our call once again Bill Wallace, our Chief Investment Officer. Bill's in our Salt Lake City, Utah office. Bill is over our investment committee and runs our investments team, and we're grateful for him. Also participating will be Sean Woods out of our St. George, Utah office. Sean is our Director of Investment Research, key on the investment analysis side. And so we'll have some participation from Sean. And then also we have Ammon Christensen in our Salt Lake City, Utah office. Ammon is one of our investment analysts. Does a lot of work behind the scenes, and we're grateful to have him part of this call and helping to see it go. So with that, we'll go ahead and turn the time over to Bill, and appreciate everyone's time and attention today.
Thank you, Clark, and welcome everybody to this quarter's update call. Hopefully you'll find the information that we're sharing helpful to understanding how we make investment decisions and what our outlook is for the markets and the economy. As you see in our agenda here, we are going to focus first on economic and market outlook, the market fundamentals and economic fundamentals. Three areas that we're going to take a little deeper dive on is a COVID update, kind of a geopolitical outlook, and also a bit of a deeper dive on inflation. And then we'll go into our investment themes and talk to you a little bit about what we've been doing in the portfolios most recently, and how the outlook and the fundamental outlook is impacting our investment decisions. So as we go to the first slide here, this is what we hope is a good summary slide for you to perhaps refer back to when appropriate. But it's also top of mind thinking and broad outlook thinking. These are some of the things that are most frequently on our mind. Some of them tend to be the same things over again, but there are new additions that come and go. Again, interest rates still very low, which we think is attractive for equity investments relative to fixed income investments, and you'll see how we're managing that. Gross domestic product has been very strong. The latest quarter was 6.4%. We're seeing forecasts and forecasting ourselves of a GDP growth of 6 to 7%. Keep in mind that that's following a decade of growth that averaged in the 1.5 to 2% range. So very strong growth out of this recovery, and so that's important to note. Corporate earnings plays an important role in our outlook. You'll note that that as we get into it more, profits and corporate earnings look to be very good in 2021 and 2022. We'll note too that margins in businesses are very strong. Fed policy continues to be very accommodative. That's positive for the equity markets. And the Fed is signaling that unlikely to have any kind of rate increase in 2021 or 2022. Perhaps those hit in 2023. The tapering activity that the Fed would initiate first before raising rates could come closer. And we do think that that's becoming more data dependent. Inflation's one of those things that could cause the Fed to have to perhaps start tightening earlier than they're originally thinking. We'll talk more about inflation as we get into things. The valuations, we'll talk a little bit more about that. Valuations, if you just look at the price earnings ratio, they do look high relative to historical price earnings levels, but we believe it's important to take a deeper dive on valuations, and we'll be doing that today. Regulation is something that's always on our minds. The new administration has a bias towards more regulation. Overall, we think that more regulation will likely impact the growth rate of the economy. It won't stop growth, but it could slow growth. So we'll be watching that carefully. Geopolitical risks. We think this is an area that there's current complacency among investors and in the markets. And if something unforeseen were to happen there, we think the markets would probably take it fairly hard. And we'll talk a little bit more about that. As we've said, in this lower interest rate environment, there's a risk to perhaps give up on fixed income. We would still say that fixed income is an important diversifier in portfolios. Despite low yields, it's still important to try to have that as an important component in your portfolios. We'll be talking a little bit more about interest rates too as we get in further in. Fiscal policy, we believe that the fiscal policy is expansionary on a short-term basis, but the policies that are being implemented will help the economy in the short run, perhaps 12 to 18 months, but they won't really have lasting positive impact. And lastly, maybe this is part of a little bit deeper dive, and this is new. We've put tax policy on here. We're noting that there's a pretty strong desire and plan within the new administration to raise taxes. And we think that could lead to basically slowing or a reduction in corporate profits, a reduction in consumer spending, a reduction in capital investment, or the 3 C's you might want to say, that those things would all negatively impact the economy. It wouldn't necessarily push us into a recession, but it would make growth harder to obtain. I'm going to stop there and just see Hammond or Sean, do you guys have anything to add here at this point?
Okay. Bill, I think we'll get into the inflation piece a little bit later, but this is certainly a hot topic right now. I think the concern around the Fed acting earlier than anticipated, I think we'll get into that more, but hot topic right now.
Yeah, for sure. So as we jump into now with COVID, and the latest Delta variant has been of concern to the financial markets. Occasionally, if there's a tough down day, that's kind of what's pointed to. We like to step back and get some perspective, and we've got a couple of slides here that hopefully is indicative of the research and conclusions we've come to. First off, the graph on the left here just shows the level of positive tests in COVID cases. It also shows the reported deaths, and you can see there's been a dramatic decrease in both reported cases and reported deaths. Thankfully, it's been wonderful. The vaccines have proved to be very effective, and we think that trend continues. On the right-hand side here, this is information on the Delta variant that really came out first in the United Kingdom, but it compares the overall rate of SARS infections, which 3.35%. Keep in mind that this is known infection, so there's probably other infections that happen that would perhaps push this rate down, but 3.35% has been the overall rate, and right now we're dealing with rates in the range of 0.1%. So although the Delta variant, I think, could be a bit of a problem for the markets, I don't think we think it's a problem for the economy in the longer term. One of the things we've noted in our research is the pandemic comes in waves, and we are essentially hitting the fourth wave, and some of the experts that we've heard and listened to are suggesting that this fourth wave should be the last wave of this pandemic. Hopefully that's true. We've also heard that the Delta variant shouldn't last very long. So bottom line there is, I think we think that this will pass, and that we won't see any real material negatives. This next slide here just shows how effective the vaccinations have been. So as you look at the graph here on the far left, this is total world vaccinations, and then US vaccinations is on the lower light blue line. So vaccinations have gone up. If you look at the middle chart here, this shows the vaccine rollout in Israel. One of the reasons Israel's has one of the better data sets to look at, but you can see here as the vaccination rates have gone up, the experience of infections have just plummeted. The next is US data. Again, you see as the vaccination rates go up, the infection rate really goes down. So I think these are reasons why we feel like we are going to continue to move out of this issue, and the markets will be able to focus on other items. Shifting gears on geopolitical risk, and this chart's kind of interesting, and let me explain it to you. Essentially, what they do here is they do data searches for how many articles are being written about geopolitical risks and concerns and issues. They take out ones that are positive and basically focus on, how much is the market and the press talking about geopolitical problems and geopolitical concerns. And the interesting thing about this chart is we're now in this negative territory over to the right, which essentially is saying compared to a 5-year average, there's a lot less talk about geopolitical issues. So that's raised a concern in our mind that if something does happen geopolitically, whether it could be US-China relations, Gulf tensions, cybersecurity issues, there's a myriad of things we could list. We just wonder if the markets kind of become a little bit complacent in that area, and that if some sort of geopolitical issue came up, that could cause a correction in the markets. That's something that is tough to follow. Those are those kind of black swan events, if you will, that can be difficult to see coming. Well, shifting gears here, let's talk a little bit about inflation. The Federal Reserve and central banks around the world have been targeting inflation as one of their main metrics for their economic and central banking policies. And they've been they want to average 2% inflation. We've typically been below 2% for most of the past decade. But most recently, we've seen a big spike in inflation. You can see here a 4.9% annualized CPI report for May, a 5.3% in June. You see how we've popped up after kind of a pretty long period of pretty benign inflation. The question is inflation going to be transitory? That's what the Federal Reserve is arguing, is that inflation will be transitory, meaning it will quickly come back to more normal levels, at least more normal in terms of the last 20 years or so. We'll see. We wanted to take a little bit more of some of the things that we think about as we're trying to decide how concerned should we be about inflation in our portfolios. As you'll see here, we've got factors pushing inflation higher. There's the supply disruption that you're all familiar with. There's interesting pandemic-driven demand for, like, example, in housing and autos that we've seen. There's also a potential as we come out of COVID for a release of pent-up demand, which we've seen in travel and services, for example. China has had a pretty strong recovery, as has the US. China tends to be a big user of commodities, and we've seen commodity prices get pushed up. The US dollar is most recently has kind of been strengthening due to a bit of a flight to quality with current concerns, but nonetheless, the US dollar is down about 1.5% year over year. So those are things that are pushing inflation higher. Pushing inflation lower, we have a high savings rate. A lot of people are conservative, have been saving money at high rates. We still have an unemployment problem. We obviously have jobs waiting to be taken, but there is that issue that could push inflation lower. The velocity of money has been low. We, as you know, from our last meeting, are concerned about the growth of the money supply, but so far that velocity has been low. And other really major factors is technological innovation and globalization of the world economy tend to keep inflation low. I would have to say that right now, our base case in our investing is that inflation will be transitory, that it's not going to get really out of control. I would also say that a higher for longer type of scenario would not surprise us, and we've also factored that into our portfolios, and I think you'll see that as we get to that part. Ammon and Sean, any thoughts on inflation that you feel like we should emphasize more?
Yeah, Bill. I mean, I think one of the concerns about the market is inflation going to get higher than expected and going to cause the Fed to raise interest rates sooner than anticipated, and that's kind of what the market's trying to digest right now. You had 13 of the 18 FOMC members, they do their dot plot, projected that they would raise rates by 2023. You had 7 of the 18 predicted it would happen sometimes next year. So there's certainly some uncertainty around, but that's the issue is if we're going to get higher than expected inflation, and will it cause the Fed to act sooner than how the market's priced securities currently. And like you said, our base case is transitory. I think we've allowed, for the possibility that inflation does go higher than expected, and we've positioned portfolios, for some of that. But that's really kind of the issue at hand right now in terms of inflation and the markets.
That's exactly right, Sean. And if the Fed has to raise rates, I mean, essentially inflation should lead to higher interest rates. And if the Fed has to do their, reduce their accommodation, the market's not really prepared for that. And at least in the short run, it could cause some heartburn for the markets. Thank you. So let's shift gears and talk about valuation. And I know you probably hear a lot in the press about the market's overvalued. And if you look at the price earnings ratio in a vacuum, then yes, the market is overvalued on a price earnings basis. You can see here the 25-year average for the S&P 500 is 16.7 times earnings. We're at 21.5 times earnings right now, so we are above normal. I would note that there has been some multiple reduction of late. That's probably primarily due to larger corporate profits. But I think we would submit to you that just looking at the price earnings ratio and saying the market's overvalued is probably you need to take a little bit deeper look and deeper dive. So this next chart here shows you corporate profit growth, you can see there's been dramatic growth in corporate profits over time. One of the really important things I think here is, we did have a drawdown in corporate profits in 2020. You may remember from the last time we met that when the market corrected significantly in March of 2000, in March and April, the market was basically forecasting an 80% reduction in profits. We ended up having about a 20% reduction in profits, give or take. And so we're working off a better base, and you can see here, now these are forecasts, so there's no guarantee here, but you can see that profit growth looks to be really robust. And that's a key component of why we are overweight right now in our equities versus our fixed income allocation. This gray line shows corporate profits. The green line here shows the price return of the S&P 500. So you could maybe argue there's a little bit of maybe more than a little bit of a disconnect there. Corporate profits have been growing faster than the market's been going up. And then secondly, and I mentioned this earlier just a moment ago, we actually have seen some decrease in multiples. So that's a positive. The multiples are still high, relatively speaking, but they are coming down. Ammon, do you have a comment?
Yeah, I think one of the interesting things that we've been monitoring about corporate profits, and it's interesting, coming out of COVID, I think a lot of companies had to adjust and really try and figure out how to right size their business. And out of that, we've seen a lot of margin growth in the underlying businesses. In fact, gross margins are as high as they've ever been. So we look at these corporate profits and we look where the growth is coming from when we do analysis on the underlying earnings. And we think a lot of that, particularly the margin growth, may be here and it may stay around. So this earnings growth has some strength to it.
Great point. And thanks for bringing that up, because I did want to emphasize that. And the other side of that is not only are gross margins higher, but net margins are better too. One of the phenomenons, which isn't really surprising, but corporations around the country, they took steps to strengthen their businesses during COVID and to prepare for what could have been a longer term horizon, and so they've watched their expenses more carefully and so forth. So that's the other side of that equation, is corporate expenses appear to be lower. Let's jump into interest rates, which is another really important part of our outlook for equities. This just shows different yield curves. Here's from 5 years ago or so. Here's the most current. Here's one where we were in August of 2020. So when we were still dealing really in the heart of COVID issues. So interest rates have increased. We've gone from a historical low in the 10-year Treasury in that 0.5% range to about 1.3%. We're actually a little bit lower than that today. Keep in mind that the 10-year was up around 1.75% just a couple of months ago. So we've seen a reduction in long-term interest rates. But that's an important part of the evaluation here. And you'll hear us say you got corporate profits increasing and you've got interest rates very low. Well, when you actually look at that, and again, moving beyond just pointing to the price earnings ratio and saying, the market's overvalued. If you look at a capitalized profits model, which essentially says, let's look at profits, let's do a calculation factoring in interest rates, and let's see what the value of the S&P 500 index should be. So if you see here, the darker blue line is where the S&P is right now. The lighter blue line are the capital profits model if you just took it off of current interest rates. So there's a gap in valuation. If you looked at this study here, this essentially says actually the markets are undervalued in terms of the level of interest rates and the level of corporate profits. To be conservative in this calculation, rather than using the current 1.3% interest rate, we're using a 2% interest rate here. And basically that red dot is what that calculation would say where the market's full value is, or fair value. So again, even at that higher interest rate, the market is trading below that level. So this is a key reason why we still think the equity markets are an attractive place to invest. Sean or Ammon, any thoughts to add there? Okay, let's move forward. A little bit, more about the Fed policy. As you can see here, we're again at this very low rate environment. We were very low rates for a number of years. We started to see rates go up, and then they went down substantially. They would have probably continued to go up if it weren't for COVID. But when COVID came, the Fed came into a very accommodative position. And as Sean mentioned earlier, an expectation for interest rate increases isn't really occurring until 2023. Again, if inflation tends to be higher for longer, that could put pressure on the Fed to bring all of those expectations in, and that could be harder for the market.
Hey, Bill, I'd just add too, I mean, back in August of last year, the Fed normally has a mandate of 2% inflation. They came out with their program of average inflation. They're not really completely clear on the time period that they're going to average, but essentially what they've done is we've kind of been in this period where we've been pretty low inflation on the PCE index. And so essentially what they've done by saying average inflation, they've bought themselves time is what they've done. So, if we were at 1.5% average inflation the past 3 years, you could foreseeably be at 2.5% in average inflation to get to that 2% inflation mark. So they've bought themselves some time with that new initiative back in August of last year.
Yeah, good point. And one of the things could be a potential concern is maybe they are too complacent and let inflation get a little bit too rampant, and then it becomes harder to rein in inflation. So this is new type of Fed policy. I think normal Fed policy of the last 30 or so years probably would have been the Fed would be raising rates right now. So that new average number that Sean refers to is allowing the Fed to kind of take its time. And maybe they will be correct in the changes they've made. Well, what I want to do now is just quickly go over what we're doing in portfolios. Again, our base case, as we said, on inflation is it will be transitory, but we also recognize that there's potential that it won't be. We're in uncharted waters, and typically, if you look at historical inflation experiences, there's really disbelief that inflation is going to be an issue, and then all of a sudden it is. So we continue to have an allocation to inflation protected securities. Those are U.S. government bonds that receive a regular adjustment to the consumer price inflation number. So fixed income is inflation's not good for fixed income investors, and so these inflation protected securities ameliorate that issue. We're also running, we're showing here 80% of benchmark duration or benchmark maturity. So essentially, we're keeping our average maturity in your fixed income portfolio shorter than the market in general. And what that means is that we're less concerned about increasing interest rates. So that's another way we're protecting. If inflation were to surprise on the high side and interest rates need to go up, our portfolios should do better in that scenario with that shorter average maturity. We are overweight equities and underweight fixed income. And as an example, what we mean by that is, if you took, for example, our balanced moderate allocation, we specifically decided to underweight fixed income by 5% and overweight equities by 5%. And so we're making a tactical decision that that's going to be good for our portfolios. An interesting thing to note is that if you were looking at a balanced moderate allocation, our overweight got up to 8% based on just purely market increases. And so this week and in our last investment committee meeting that we held just recently, we decided, well, we're okay being overweight. We don't want to be that far overweight. And we have trimmed that back to that 5% we were willing to do. So we have taken steps recently to take some profits, if you will, and reduce that overweight. In conjunction with that, we moved to a full weight in real estate investment trusts, which are marketable ways to be invested in real estate. And we moved that to a full weight. And the underlying asset there is a hard asset. Hard assets, physical assets, tend to do better in an inflationary environment. So that's another step we've taken to kind of hedge our bets on inflation. We're also considering adding floating rate fixed income into our portfolios. Those are loans, for example, that you make where there is a floating interest rate. So they are also protected. If you're in a floating rate investment, you actually wouldn't mind to see interest rates go up because your rates will adjust upwards more quickly than regular fixed income. And also we are still overweight small and mid-size U.S. companies. But that is an area where we trimmed our equity exposure. We have a pretty big overweight there. We're later in the cycle. And so we've determined that that would be where we would reduce our equity for those additions to a small addition to fixed income and a small addition to REITs. Sean and Ammon, anything you would add there?
I mean, I would just maybe add on the REIT move, like Bill mentioned, it's part of our way to, REITs do extremely well on higher than expected inflation environments. There's also some attractiveness right now with valuations. Usually the premium on valuation for REITs relative to equities is at a certain level, and right now it's below that. So attractive valuation even relative to equities on the REITs. And then the other aspect of REITs is they perform well in a rising interest rate environment as well. So we're to neutral weight on that, and think it's a good move. We've seen some nice move in real estate this year. We've been only slightly underweight in that, and we're just to a full weight now.
Thank you. So I'm going to wrap up here, and then we can open it up for questions. There we go. So key takeaways, just around, equity still attractive relative to fixed income due to profit growth and low interest rates. We've taken steps to protect your portfolio from potentially rising inflation. Small and mid-cap stocks still look attractive, but we have moderated our overweight there. Again, we make another plug. In spite of low interest rates, fixed income is still an important part of, risk reduction characteristics for a portfolio allocation. We also say be careful about stretching for yield. We have done things to try to enhance yield, but we also want to be mindful that as you do those things, you're going into riskier fixed income securities. So we're careful in that approach. And then again, an unexpected geopolitical event could be disruptive to the financial markets. So Clark, I'll stop there and see if we have any questions.
Thanks, Bill and Sean and Ammon, for your thoughts. been very helpful. Couple of questions, and maybe I'll kind of try to preface the first question a little bit. Note that the emerging markets year to date are up through last week about 3%, and U.S. markets are mostly somewhere in the mid-teens year to date in terms of their performance. So do you think, the question is, do you think we're already in correction territory or bear market territory in Chinese stocks? And how has that influenced our Soltis's overall exposure to emerging markets?
We're not in bear market territory in emerging markets. They have not done as well as U.S. markets. Our position in emerging markets is, any of the investments we make, we tend to make them for a long-term basis. So our decision would be not so much do we invest in emerging markets, but do we have more there than perhaps the typical investor, or do we have less there than the typical investor? And our portfolios right now are essentially fully weighted into emerging markets. We're sticking with that position as of now due to a few factors, and Sean and Ammon, feel free to help me here, but one would be attractive valuations. Another one would be an expectation for profit growth. The profit growth that had been forecast for emerging markets was essentially double what we were expecting in the U.S. So we think that there could be a substantial growth recovery. And then lastly, it's anytime we go into international investments, we're getting a hedge from the U.S. dollar going down. And, we just think with our monetary policy as it is right now, that could be a factor that pushes the value of the dollar down over time, which again, emerging markets are a good inflation hedge there. Sean and Ammon, anything you'd add on that?
Yeah, I mean, when you look at emerging markets over the past year, they're up almost 41%. And prior to the pandemic, I think we liked emerging markets for some of the reasons Bill mentioned. I mean, particularly the price to earnings ratio is particularly attractive. Like if you look at the PE on emerging markets, right now they're trading at about 14 times earnings. You compare that to like the broader global index where we're at like 19 times earnings, 20 times earnings on that. So there's a valuation aspect of it. The other thing that's kind of worth noting is, some of these emerging markets, they weren't afforded the opportunity to do the kind of fiscal and monetary stimulus that some of the more developed economies were able to do during the pandemic. And we've certainly seen our deficit grow through that, to a pretty high level. Some of these emerging markets they weren't afforded that opportunity maybe. And so their balance sheets look a lot more attractive right now. I think we'll watch as COVID plays out and vaccinations happening in these emerging markets. But from a valuation standpoint, it look really attractive right now. And there's certainly some tailwinds behind a weakening dollar and some of the different exposures there in emerging markets. So.
Maybe just to piggyback a little bit off of the discussion about emerging markets and particularly China, the question comes, another concern is getting hit with a cyber attack on top of the Chinese conflict. How can we get exposure to more cyber technology?
Yeah, so we have a couple of our individual stock portfolios. I would say the growth portfolios where exposure to this, we may get some from time to time. And I know me being a co-manager on that with lead manager Hal Anderson, it's something in a theme that we monitor from time to time. We add themes like cybersecurity. That's something we're monitoring. So I would say if there is a client that's interested in getting specific exposure to cyber technology, and specific exposure to different themes and particular stocks, the growth portfolio or the equity income portfolio would be the places to be. Like I said, currently we don't have specific exposure to that theme, but I think it's something we're monitoring as a team.
I would also mention that, you know, our portfolios tend to be broadly asset allocated. We really start with asset allocation. We start with, and then we look at, you know, we look at each individual investor's risk tolerance and goals. And our allocations tend to be more, you know, going into a specific industry sector is very narrow. Most of our work is done at the asset allocation level. I think in terms of a cyber security investment, you know, we're thinking more that the underlying managers that we select would be making those investments as they see warranted. As Ammon's indicated, the only place where you might see like a specific cybersecurity investment would be in one of our individual large cap equity portfolios. That would be unlikely to happen in our equity income portfolio because a cybersecurity company is very unlikely to meet the kind of income metrics that we're looking for in that portfolio. In our growth portfolio, the cybersecurity might make more sense there. But again, overall, we're focusing on broader allocations for the most part.
And Bill, I would probably just add that, you know, in our large cap, you know, the large companies with assets are probably your most probable target for this type of thing. And so, you know, our managers are going out and finding these high quality companies that recognize this as a threat and are devoting resources towards protecting their business in that. So, I mean, on the other side of it, we are investing in companies that recognize this as a threat and are certainly have devoted resources to it. And we have great managers that are uncovering these type of companies.
Thanks, everybody. Maybe just one more question before we go ahead and conclude. Kind of an interesting question coming out on the tax side and their effect on retirement plans. So a little outside the scope of economics, but it's an interesting question that maybe we could comment on. So what are thoughts from Soltis on rumors of the government attacking 401ks or the tax benefit 401ks and cash? Any thoughts on how that, you know, any rumors or things that we're seeing?
Well, I haven't seen anything in basically that the government might change how those are taxed. Or, I mean, if you look at a traditional IRA, that's already, when you start taking that out, that's already subject to income taxes. If you look at a traditional 401k, again, those are already subject to income taxes. The Roth 401ks, which are becoming more common for use, but perhaps more so in the younger generations, less so in the baby boomers. Those, when you take money out of those, they're not subject to income tax. And I suppose there's always a chance the government could reverse course and say, well, we changed our minds, we're going to start taxing Roth distributions as well. But I haven't heard anything just beyond. I think the term rumor is probably a good way to put it. And I haven't seen anything substantive there to have that affect your financial plan.
I would just underscore and add to what Bill said. This is Clark. We hear a lot about that. We've heard a lot about that for several years, even decades over time. I think some of that, it would be highly unlikely. It would be very difficult for the government to do something like that. Is it impossible? Perhaps not, but unlikely in our view. So we think that that's probably not the most prominent concern today. So with that, we'll go ahead and again, thank you everyone for joining the webinar. Appreciate everyone's attention and participation. We did record this webinar. If for those that may have missed it, we can happy to share it. And we will be communicating very soon about upcoming events. Thank you.